Welcome back to We Are Cosmic. I'm really glad you're here today because what's happening right now in the crypto market is not normal, and most people are completely misreading it. Prices are falling, fear is rising, and headlines are screaming panic. But if you're only watching red candles and price charts, you're missing the real story. And today we're going to talk about the story behind the chaos. Let me start with a simple question. If crypto is dead, then why are governments rushing to pass crypto laws? Why are banks fighting over stablecoins? Why is Wall Street suddenly sitting at the same table as DeFi builders? And why are projects like Ripple still building quietly while the market bleeds? These questions matter because markets don't crash randomly. They move when pressure builds behind the scenes. Right now, Bitcoin has dropped below levels most people thought were unbreakable. XRP is defending critical support while the entire market is bleeding. Altcoins are getting crushed, and naturally people are asking, is this the end? But history tells us something very different. Every major financial shift looks ugly before it looks obvious, and what we're witnessing now is not the collapse of crypto, it's the stress test before clarity. On this channel, we are cosmic, we don't chase hype, and we don't panic with the crowd. We focus on structure, regulation, capital flows, and long-term winners. Crypto is no longer just about speculation. It's about infrastructure. It's about who survives regulation and who disappears when the rules finally arrive. And that's why today's conversation is so important. Over the last few days, major crypto legislation has been delayed. That delay spooked the market. But here's the part most people don't understand. Delays don't mean failure. In politics and finance, delays often mean negotiation, pressure, and power struggles. Banks are worried about losing deposits. Stablecoin yield is a battlefield. Self-custody and DeFi are still uncomfortable topics for regulators. But none of this means crypto is going away. It means the system is adjusting to something it can no longer ignore. What's fascinating is that while the bill was delayed, prediction markets actually increased the odds of it passing. Think about that. The market is scared, but smart money sees inevitability. When fear rises and probability rises at the same time, something big is forming underneath the surface. And let's be clear about one thing. Regulation is not the enemy of crypto. Bad regulation is. Clear regulation unlocks capital. It allows institutions to move. It separates serious projects from weak ones. And historically, the projects that did the hard work early are the ones that benefit the most when clarity finally arrives. This is why names like Ripple keep coming up. This is why stablecoin issuers like Circle matter. This is why infrastructure players quietly positioning themselves are far more important than meme-driven hype cycles. When rules come in, speculation fades and utility takes over. Now, if you're feeling uncomfortable right now, that's normal. Markets are designed to shake people out before the next phase begins. Oversold conditions don't mean immediate recovery, but they do tell us one thing clearly. We are closer to the end of this move than the beginning. Fear always peaks near bottoms, not tops. Now let's talk about the moment that triggered a lot of this fear. The delay in crypto legislation. When headlines say crypto bill delayed, most people immediately assume something went wrong. They think regulators are backing away or that crypto is about to be shut down. But that's not how policy works, especially when powerful interests are involved. The legislation we're talking about is designed to bring market clarity. That means defining who can issue stablecoins, who can offer yield, how custody works, and how banks and crypto companies coexist. This is not a small bill. This is a bill that decides who controls money rails for the next decade. Of course, it's going to be delayed. Of course, there's going to be resistance. One of the biggest reasons for the delay is banks. Traditional banks are worried about deposits leaving their system and moving into crypto-native products. Stablecoins that offer yield are especially dangerous to them. Why would someone keep money in a bank earning almost nothing when a regulated stablecoin could offer more transparency and better returns? That's the real fight happening behind closed doors. So when you hear lawmakers talk about concerns, understand what they really mean. They mean pressure from banks, credit unions, and legacy financial institutions that don't want to lose control. This has nothing to do with protecting consumers and everything to do with protecting balance sheets. Now here's where it gets interesting. Even though the bill was delayed, the probability of it passing actually went up on prediction markets. That tells us something important. It tells us that negotiations are tightening. There's less room to stall, and the market itself is forcing action. When prices are high, politicians kick the can down the road. There's no urgency. Everyone wants a perfect bill, but when markets fall, urgency appears. Suddenly, clarity matters. suddenly uncertainty becomes dangerous. And that's exactly what we're seeing now. Bitcoin dropping below key psychological levels didn't happen in isolation. XRP defending support didn't happen randomly. This is a pressure environment, and pressure environments force decisions. That's why parties that were once refusing to compromise are now being pulled back to the table. Another important point here is leverage. Earlier, big crypto companies had leverage. They could say, we won't support this unless we get exactly what we want. But leverage disappears when markets fall. When prices drop, capital tightens. Investors get nervous, and suddenly passing a workable bill becomes more important than passing a perfect one. This is why the conversation has shifted. Instead of arguing over every detail, the focus is now on getting something done. Markets don't like uncertainty, and right now, uncertainty is the biggest risk asset in crypto. It's also important to understand that this delay actually benefits some players. Banks buy time. Institutions prepare their infrastructure. Projects that are already compliant quietly gain an advantage. Meanwhile, weaker projects that relied on regulatory chaos are getting exposed. This is why I've said many times that regulation doesn't kill crypto. It filters crypto. It separates long-term infrastructure from short-term speculation. And that filtering process is never comfortable. If you zoom out, this looks very similar to earlier moments in financial history. The internet didn't explode the moment regulations were discussed. There were fights, there were delays, there were powerful companies trying to shape the rules in their favor, but once a framework existed, innovation accelerated. That's where we are now. This market drawdown is not just about prices, it's about transition. Crypto is moving from the Wild West into regulated infrastructure, and transitions always create volatility. When rules become clear, speculation loses power and fundamentals take over. That's when hype-driven projects fade and real infrastructure starts to matter. This is where experience, compliance, and real-world utility become more important than promises and marketing. Let's start with institutions. Large financial institutions do not enter chaos. They wait for clarity. They wait for defined rules around custody, liquidity, settlement, and risk. That's why institutional adoption always looks slow until suddenly it isn't. Once the framework is in place, capital moves fast. This is exactly why we've seen major banks, asset managers, and payment companies quietly building behind the scenes. They are not trading headlines, they are preparing systems, they are testing rails, and they are positioning themselves to move the moment regulation allows them to operate at scale. Now let's talk about crypto projects. In a regulated world, only a few traits matter. Is the network stable? Can it scale without breaking? Is it legally defensible? Can it integrate with existing financial systems? And most importantly, does it solve a real problem that institutions care about? This is where infrastructure-focused projects stand out. Networks designed for payments, settlements, tokenization, and liquidity movement suddenly become extremely valuable. Not because of price speculation, but because they fit directly into how money actually moves. Projects that were built to be compliant from day one gain a massive advantage. They don't need to rewrite their model. They don't need to scramble to meet standards. They are already aligned with where the system is going. On the other hand, projects that thrived in regulatory gray zones struggle. Their business model depends on confusion. They rely on loopholes, unsustainable yields, or unclear classifications. Once clarity arrives, those loopholes close. This is why regulation feels like an attack to some parts of crypto. It removes easy money, it removes shortcuts, and it exposes weak foundations. Now zoom out even further. Regulation also changes how investors behave. Retail investors often chase momentum. Institutions chase risk-adjusted returns. When rules are clear, institutions can finally calculate risk properly. That opens the door to pension funds, insurance companies, and sovereign capital. That kind of money doesn't look for the next 10x meme. It looks for reliability, liquidity, and longevity. It looks for assets that can exist inside a financial system for decades, not months. This is also where tokenization comes into play. Real-world assets moving onto blockchains requires legal certainty. You can't tokenize bonds, equities, or real estate at scale without regulatory approval. Once that approval exists, the demand for compliant blockchain infrastructure explodes. And this is the part many people miss. Regulation doesn't just protect users, it unlocks markets that were previously impossible to access. Entire trillions of dollars sit on the sidelines right now because the rules are unclear. Clarity turns those sidelines into entry points. That's why this phase feels uncomfortable. We're in the middle of a transition from narrative-driven markets to utility-driven markets. Prices move violently because expectations are being reset. But if you're positioned in projects that are aligned with institutions, compliance, and real-world usage, this phase is not something to fear. It's something to understand. The market is not dying. It's reorganizing. Power is shifting from noise to infrastructure, from speculation to settlement, from promises to performance. Liquidity is not just about how much money is in the market. It's about how easily large amounts of capital can move without causing massive price swings. Institutions care deeply about this. They don't chase pumps. They need deep liquidity, predictable execution, and minimal slippage. When liquidity is thin, price becomes easier to manipulate. Small amounts of capital can push markets up or down. This is why you often see sudden drops that feel disconnected from fundamentals. It's not panic selling from everyone. It's market structure doing what it does best, searching for liquidity. Right now, liquidity is being pulled back. Central banks are cautious. Interest rates remain high. Risk capital is selective. That creates an environment where volatility increases, even if long-term adoption is moving forward. This is why you'll often see strong networks with real partnerships trade sideways or even fall while weaker assets pump temporarily. Price action in these moments reflects positioning, not value. Smart money is not chasing green candles. It's building exposure quietly when liquidity is low and attention is elsewhere. Another key concept here is order flow. Large players don't buy in one click. They scale in over time, they wait for sellers, they let price come to them. That process looks boring and sometimes painful from the outside. This is why support levels matter so much during these phases. Not because they predict the future perfectly, but because they show where demand consistently appears. When price repeatedly defends a level despite negative news, that's a signal. It tells you that someone with size is absorbing supply. Retail traders often interpret this as weakness. They see no movement and assume nothing is happening. But in reality, this is where positioning happens. Institutions prefer silence. They prefer low volatility. They prefer moments when the crowd is distracted or discouraged. This also explains why breakouts often feel sudden and unfair. One day, nothing happens. The next day, price moves aggressively. That's not randomness. That's the result of accumulation reaching a tipping point where supply dries up. Now let's talk about fear. Fear is a liquidity event. When people panic, they sell into bids. That creates opportunities for those who understand structure. This doesn't mean every drop is a buying opportunity, but it does mean that emotional selling often benefits disciplined capital. Another layer to this is derivatives. Futures, options, and leverage distort spot price. Liquidations create forced selling that has nothing to do with fundamentals. When leverage builds up on one side of the market, price moves in the opposite direction to reset the system. This is why sharp wicks and sudden crashes are more common now than in earlier cycles. The market is more complex. More instruments exist. More ways to express risk exist. And that complexity creates noise. But underneath the noise, structure remains. Liquidity moves where it is needed. Capital positions where risk is mispriced. And price becomes a tool, not a truth. If you only look at charts without understanding who is trading and why, you will always feel late. You'll buy strength and sell weakness. That's exactly the behavior institutions rely on. Understanding market structure changes your perspective. Red days stop feeling like personal attacks. Sideways markets stop feeling like wasted time. You begin to see them as phases, not failures. Every crypto cycle has similar phases. First comes disbelief, then slow accumulation, then excitement, then euphoria, and finally fear and exhaustion. Most people think we're always either at the top or the bottom, but reality is more nuanced. Right now, we are not in a euphoric phase. We're also not in a true collapse. We are in a transition phase. This is the part of the cycle where infrastructure is being built, rules are being defined, and capital is repositioning. This phase feels boring and frustrating. Price doesn't move the way people expect. Narratives change constantly. One week the market feels bullish, the next week it feels broken. That emotional whiplash is a feature of this stage, not a bug. Historically, this is the phase where strong hands are formed. People who survive this period are not the ones chasing headlines. They are the ones who focus on structure, fundamentals, and time. Another important detail is that cycles are stretching. Earlier cycles were fast and wild. Today's market is larger, more regulated, and more connected to traditional finance. That slows things down, but it also increases stability over the long term. This is why patience has become an edge. When markets move slower, emotional reactions become more expensive. Overtrading, constant switching, and chasing narratives usually lead to underperformance. We also need to talk about expectations. Many people entered crypto expecting instant results. They were trained by previous cycles where everything moved quickly. But as the market matures, those explosive moves become rare and more selective. That doesn't mean opportunity is gone. It means opportunity has shifted. Instead of broad market pumps, value concentrates in specific areas. Infrastructure, payments, tokenization, settlement. These are not flashy stories, but they are powerful ones. This is also where psychology matters. Most people quit during this phase. They get tired. They lose confidence. They convince themselves they missed the move. That's why cycles work the way they do. Markets reward those who can stay rational while others disengage. Another sign of this phase is narrative conflict. You'll hear extreme opinions on both sides. Some will say crypto is dead. Others will say a massive breakout is imminent. The truth usually sits in between. Progress is happening, but it's uneven. And here's something important. Institutions prefer this phase. They don't like hype. They like quiet markets where they can plan, test, and allocate without pressure. By the time the public notices, positioning is already complete. This is why many of the biggest gains happen after long periods of boredom. Not because something magical happens overnight, but because groundwork finally meets liquidity. So if you're feeling confused or tired right now, you're not alone. That feeling is part of the cycle. The key is not to fight it emotionally. Instead of asking why isn't price moving, ask what is being built right now. Instead of asking did I miss it, ask who is preparing, because cycles don't reward urgency. They reward alignment, and in the final part we're going to bring everything together. We'll talk about how to think clearly in this environment, how to protect your capital, and how to position yourself intelligently without chasing noise.